What's up, everyone? It's Caddy with Money Vesting, and Jerome Powell once again kind of repeating his speech from the day before at the U.S. Financial Services Committee. And markets were very flat, so very uneventful day with the S&P only up 15 basis points. We got the Nasdaq up 40 basis points, but we did get some economic data, so I'm going to break that down, and we're also going to talk a little bit about a potential deflationary depression. There was a very good report and research study put together by Nick Gurl on Twitter. Shout out to him. So we will be talking a little bit about that as well. As always, if you guys enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, swing trading ideas, and a lot of other private videos as well. So first things first, talking about the ADP employment report, because that is what this week is all about. It's about employment. And we're going to get the actual employment non-farm payrolls report on Friday, March 10th. But ADP, we pretty much added a little bit over 240,000 jobs in the month of February versus the consensus of 200,000 jobs. So once again, labor market super tight, coming in really hot with those numbers at 242,000 jobs, which once again paves the way for the Federal Reserve to keep hiking rates. This right here was the MBA mortgage applications week over week for purchase, refinancing, and for general mortgages. So 7.4% increase. Prior weeks, we have pretty much seen a contraction. And we also know that the mortgage applications have hit a 28-year low, coming down to the same levels from back in 1995. So we are definitely seeing a lot of demand pull back on mortgage applications as interest rates continue to push higher, and mortgage rates are sitting at well over 6.5%, closer to 7%. However, for this week over week number, we did see a pretty substantial increase once again for mortgage applications, 7.4% on a composite basis, purchase index up 6.6%, and refinancing activity up 9.4% week over week. This right here was a JOLTS number. So how many job openings in the United States in the month of January? So we are now down to 10.824 million job openings in the US. The consensus was 10.6. So once again, we came in a little bit hotter, and the revision has been down from 11.234. So this right here was a number prior to this report. So this was from back in December of 2022. And for January of 2023, we're sitting at 10.824 million jobs. So once again, if you plug these numbers into our spreadsheet, 10.824 with unemployment persons sitting at 5.81 million, now this ratio has come down to 1.86 from 1.9 to 1.86, meaning that there's 1.86 job vacancies for every one unemployed person in the US, and that's down from 2 last year. So the job market still pretty tight, still very strong, so to speak. And this right here was a report, and I'll go over that in just a minute, from Nick Gurl on Twitter. Again, shout out and credit to him. But going to that prior, just talking a little bit about US subprime auto delinquency rates, and they are now getting up to over 6%. So we have been creeping higher and higher, and we are now higher than the same time we were during the Great Recession of 07 and 08. So this is quite concerning in my opinion, as consumers kind of hit a wall against their debt levels, and at the same time the savings rate continue to deplete over time right now. Delinquency rates, not only in the auto market, but even in mortgages and credit cards and just regular business loans and personal loans, could start to creep up as well. And that could definitely be a very strong indicator of a potential weakening consumer, which could lead to weakening earnings, which could lead to, of course, equity prices rolling over as well. So definitely something to pay attention to because of delinquency rates. We've talked about it in our other video where we talked about consumer spending, consumer savings rate, and the debt levels as well. So this right here was that report, and this is very interesting because the money supply, we already know, is now contracting. But if you compare to how money supply is done in the last 150 years, every single time, 4 out of 4 times, money supply has declined, or in other words, it has been negative. It has been preceded by a depression, not a recession, not anything else, but a depression in the US. If you take about 1870s, there was a depression, unemployment got up to 14%. Panic of 1893, unemployment got up to 18%. And again, there was a depression in the US. And this right here, 1921, depression and 11% unemployment, with the Great Depression happening in the 1930s with an unemployment rate of 25%. And right now, we're sitting at -2% for the money supply. So money supply coming down is in theory very, very deflationary in nature. It actually creates fewer dollars available for the money, for the economy, and as less circulation of money happens in the economy, prices come down as demand starts to kind of go away, right? Because money supply coming down is demand going away. As a result, prices coming down, which could lead to a significant deflation in the economy, which is just as big of a problem as high inflation or hyperinflation. So in the past, it's quite interesting that every single time in the last 150 years, as money supply has contracted -2%, we have seen a depression, and it's also led to deflation in the economy, because this is what really it's led to. And you'll notice that we have seen obviously money supply come down, but this is exactly what happened in Depression 1921, and this occurred after World War I and the Spanish flu, where there were years of high inflation and money supply growth, and wham, 11% deflation with unemployment rate also skyrocketing. So you'll notice that back in 1921, we saw 11% decline in inflation, down from 20% just a few years ago. So pretty substantial decline in inflation, and that's pretty theoretical, right? So it's obvious because money supply is coming down, so there's fewer dollars going around in the economy for the same amount of goods, and as a result, deflation happens. Prices come down, wages, commodities, rents, mortgages, everything starts to really pull back in that sort of environment, and that also leads to a potential depression as people start losing their jobs and unemployment rate increases. And back in 1920s, 21s, unemployment rate increased to over 10%. So definitely something to pay attention to, in my opinion. And as the Federal Reserve continues to hike interest rates, there is going to be something inevitably going to break, in my personal opinion, as the forecast for the federal funds rate is now closely getting up to 6%. Right now, the terminal rate was 5.1%, then it got up to 5.5, 5.75%, and now there's also expectations that the Federal Reserve is going to raise rates up to 6%, about 37 to 40% probability now, suggesting that we could even see a 6% handle on the interest rates, which definitely is going to contract money supply even more. So why is money supply contracting in the first place? Well, because of the Federal Reserve's quantitative tightening, right? Because of the fact that they're sucking out liquidity from the economy through the balance sheet runoff, right? So US Treasuries, they're rolling those off. And again, we've done some analysis on that as well. If you come over to our spreadsheet over here, you'll notice that since May of 2022, when they actually started the balance sheet runoff, they've gone from 5.7 trillion down to 5.3 trillion. So they have pretty much rolled over $429 billion worth of US Treasuries. So as the demand starts to go away, interest rates start going up, right? Yields go up because they are inversely correlated to price. So as the demand starts to go away from the Federal Reserve, because Federal Reserve was one of the biggest buyers of US Treasuries, but if they go away, the demand goes away, prices come down, yields go higher. And that's exactly what's been happening, right? 10-year yields have literally skyrocketed, 2-year, 1-year, 6-month. You take a look at all US Treasuries, they've just been pushing higher. And then the same concept applies to mortgage-backed securities, which are nothing but a pool of mortgages kind of put together for investors. And as the Federal Reserve buys mortgage-backed securities, that keeps prices stable and mortgage rates lower. But if the opposite starts happening, it's a way of quantitative tightening, and that's a big problem for, of course, the liquidity in the market, for the entire money supply in the economy. And they have declined that mortgage-backed securities by $130 billion since May of 22. So entire securities held outright has come down by $600 billion since May, and they're just a little bit shy of their goals right now. So far, they were supposed to do $712 billion, but right now they've only done $600 billion, so they're $100 billion, $112 billion short of their goal so far into this balance sheet reduction program. But that's only part of the problem, right? It's only balance sheet reduction that's sucking liquidity out of the economy. At the same time, they're also increasing interest rates, right? Which is a separate problem, which is also making cost of borrowing more expensive for companies, for individuals, for a lot of entities out there, and that's obviously causing a lot of contraction in money supply. And if this continues, if money supply continues to get steeper and steeper in the negative territory, that definitely, most certainly, could lead to an environment where inflation not only comes down, but absolutely gets literally railed on the other side of negative 5%, negative 10%, and that could lead to significant deflation, which you might assume would be good for the economy, but it's not really. It's really terrible for economic growth. Think about it for a second. If prices are going down and if there's severe deflation in the economy, then nobody's spending any money, right? Their demand is pretty much gone, right? If the demand is gone, there's abundant of supply, and as a result, prices continue to come down. No productivity, and if businesses are not making any money because consumers not spending any of it, then as a result, earnings absolutely plummet, and companies will have to do significant layoffs, and at the same time, earnings will decline. So you've got an environment where high unemployment and earnings decline are going to be very much a possibility in that environment. So it's definitely something to pay attention to. It's going to be quite an interesting 2023 and 2024, depending on how it all plays out. But the Federal Reserve, once again, we already know, is committed to bringing inflation down and is going to continue to raise rates in 2023. And this is the current forecast, where the probability for us to get up to 6% is now sitting at the highest 37% by September of 2023. And the market's pretty locked in at 78% probability for us to get a 50 basis point hike in the March 22nd meeting, and for us to get rates up to 5%, 5 to 5.25%, and then eventually see another 50 basis point hikes in the next couple of meetings for us to sit at over 5.5 to 5.75%, and a few cuts priced in 2024. The state of the market, Tesla here down 3%. So once again, I do have my covered calls printing. They're up almost 90%. So I will be closing those out very, very soon. Nvidia, AMD pushing higher. So entire semiconductor sector pushing through really well. KLAC, so KLA Corporation, we did a video about that not too long ago. One of the more quality stocks, up over 3.2%. We got real estate pushing higher. Energy was down. Consumer defensive was down. Healthcare was pulling back. We had Apple here slightly higher, Microsoft down. Financials slightly lower, so healthcare lower. So it was kind of like a mixed day. But semiconductor is definitely kind of leading the way here on after the Federal Reserve's testimony. So very strong moves for that sector. Nvidia, AMD, they just keep pushing higher here. And over the last 1 week, technology, utilities, comm services, all pushing higher, with every single sector here pulling back. And then over the last 1 month, all 11 sectors are underperforming, selling off. Energy, technology, industrials have kind of held up really well, but everything else is just straight up down. Natural gas here pushing higher, with the lean hogs also green, with coffee and orange juice definitely selling off quite a bit. And Bitcoin here just a little bit over $21,000, and Ethereum just over $1,500 at the moment. So quite an interesting day. Again, lots of back and forth, and bottom line is that we were just mostly consolidation. There's a lot of indecision in the market and a lot of confusion and contradictory information and economic data also coming out. I am pretty certain on the fact that we're going to see a recession in the US sometime in 23 or 24. And unemployment will go up. Like, those are two things that I feel like I am pretty confident on. There's no data out there. There's no anything that's gonna make me believe otherwise. Unless, again, make sure to chime in the comment section below and what your thoughts and what your analysis and prediction is. But I am pretty positive. Again, not 100% confident, because there's no such thing as 100% guaranteed. But I'm pretty confident that we are going to see unemployment rate rise in the future at some point, and we're also going to see a potential recession in the US, economic recession, and earnings recessions pretty much a guarantee now at this point, considering that the fourth quarter earnings declined by 5%, and first and second quarter we're also expecting a decline in earnings for the S&P 500. So those are three things that I can definitely with high probability say that I believe in. Other than that, inflation, it's going to be quite interesting. I mean, I'm still expecting some level of stagflation in 23, but with this new data, with this money supply contracting, and of course with the analysis from back in 150 years, I am, even a little bit more, we'll have to do more research definitely, but a deflationary environment is also a possibility, leading to a potential depression. But in that depression, of course, unemployment rises, and we see a potential recession, and much worse than a recession in that environment. So it really is all about inflation at this point, right? If inflation doesn't come down fast enough before a recession hits, the Federal Reserve will have to pick a side, right? They'll have to continue to fight this battle against inflation, even though the economy is deteriorating, it's worsening, unemployment starts to go up. They're not going to focus on those things unless inflation comes down. And eventually, I mean, if you take a look at the other side of this, right, if we do end up seeing, let's say, a deflationary depression, let's just go to the worst case scenario, inflation turns into deflation, goes down negative 10%, negative 11%, whatever the case might be, and we end up seeing a depression with unemployment rate rising and earnings dropping, and we see a significant reduction in prices for equities, real estate, and everything else, that's going to create the best opportunities of our lifetimes to be buyers of these assets. And the reason I say that is because when deflation happens, the Federal Reserve has the flexibility to cut rates. In that environment, they will most likely cut rates all the way back down to close to 0% once again to boost that, to boost that demand once again, to reignite that economy and to rejuvenate some of that growth. And it's most likely the fiscal stimulus also steps in to help the economy, help the consumers, help the people kind of spend once again. So if and when that happens, I mean, we got to be prepared, but that's also going to be one of the greatest buying opportunities of our lifetime, considering that asset prices will be significantly lower than where we're trading right now. But talking a little bit about the markets now, enough about the macros. So U.S. oil, once again, coming down off of $81 per barrel. So we are seeing a bit of a pullback. Support level is going to stay put at $73, $74 per barrel. We did see volatility here slightly get up to over 19, almost 20 levels, but didn't quite hold up at that level for too long, down about 2.5%, once again coming down to low 19s. And the yield curves, we talked about it, now down to negative 107 basis points, up just about 1%. But this is also an indicator of a potential recession here, considering how steep the inversion really is in the yield curve at the moment, down negative 1%, over 1% now. Absolutely crazy. Talking a little bit about the S&P 500 now. So S&P on the day was slightly higher, 15 basis points here. So we are getting a little bit of a bounce, but it's really a lot of indecision, lots of consolidation for the market. We're just going sideways. And the narrative or the story is pretty much changing every single day, where we're like going higher, lower, depending on what's coming out in the news, what's going on in the economy, and what's going on with the Fed. It's kind of like very much back and forth environment. And remainder of this week, everything that's going to be focused on is going to be the initial jobless claims tomorrow, 8:30 a.m. Eastern. Then we've got the big employment report on Friday. And next week, of course, we got inflation to focus on, CPI, PPI. And the following week, we got the Fed again. So Jerome Powell with the FOMC meeting. So lots of important stuff coming out. But for the most part, the market are very, very uncertain, very indecisive in the way they're moving. Lots of consolidation sideways. Nasdaq here, same thing, still trading above that 200 SMA, pushed up a little bit, but resistance going to stay put right over here, sitting roughly at 12,280, and support level in line with that 200 simple moving average. So all we're really seeing is a lot of consolidation sideways for the indices. Apple right now, just once again, trading sideways. Not a lot of technical analysis to be done, but resistance is going to stay put at 157, 158, with the support staying put at 200 SMA, 146, 147 for Apple, and all the way down to this higher low for the stock as well, sitting roughly at around 130s, 133, 134. I do think Apple trades at a little bit of an expensive valuation at the moment. So if it does come down in the 120s, I would be very much interested in taking part of Apple stock here. Amazon, on the other hand, just up about 40 basis points. So mostly consolidating sideways. It has been coming down, so still trading inside this downtrending channel, making lower highs and lower lows, getting rejected at that 200 simple moving average. So what we're really seeing is a lot of consolidation. Support level is going to stay put at $83, $84. So very, very strong area of support and demand for Amazon at that level. And resistance is going to stay put at this level right here, close to 110, in line with that 200 SMA and the lower high as well. Talking a little bit about Tesla, and Tesla continues to fall, which is a good thing for the covered calls that we have. And support level is going to stay put at 175, 176. So this right here is going to be that level to watch for Tesla. And resistance, we've got a very strong resistance, as you can see, previously validated support, previously rejected resistance, and right now once again we're getting rejected at that level, in line with that 200 SMA sitting roughly at 220 to 225, around those levels, and support level is going to stay put at 177 for Tesla at the moment. Talking about Nvidia, and Nvidia continues to push higher, closing in at just over 241. And right now, once again, coming up to its possibly new peak here. Of course, we're still down from all-time highs, and this is the higher highs and higher lows. This is the uptrend within which Nvidia has been trading at, but it is defying logic, it is defying gravity, it is defying everything about the fundamentals and technicals, and in my opinion, solely trading on the momentum behind the stock. The RSI, MACD continue to kind of make that negative divergence, but the price is very, very stubborn and reluctant to come down. So if we do get a successful breakout, the next resistance is going to be at 292. This right here is going to be that next level to watch for Nvidia moving forward. Advanced Micro Devices, AMD also with a very nice bounce. We've got that 300 SMA sitting at 89, closer to $90 next. That's going to be the level to watch. And of course, we're watching this as a higher high. And we've got a higher low sitting right over here. So very nice uptrend of higher highs and higher lows pushing through. So very nicely going higher. So that's going to be that resistance level to watch next for advanced micro devices. Talking a little bit about PayPal, and PayPal here on the day was up 1.24%. So lots of consolidation for PayPal. Resistance is going to be at this lower high. That's going to be somewhat in line with that 200 simple moving average. So that's going to be sitting roughly at around $81, $82. And we still have a gap to fill here. And we've got a support zone roughly at around $67 with my fair value close to $70 per share for PayPal. Square, lots of consolidation sideways as well. Resistance is going to stay put at $83, $84. So this right here is going to be that level to watch. And right now what we're seeing is a bit of a consolidation level here. Resistance getting rejected and then selling right back down. Lots of buyers stepping in here on the day. But $83 is going to be that resistance to watch for Block at the moment. This is actually a pretty strong resistance area for Block at the moment, right? So if you take a look at how we've traded in the past, lots of rejection here, so sold off, consolidated sideways, and then got rejected and sold off. This right here, same thing. We got up to that resistance, $85, $86, and sold off. And right now, once again, more recently, we sold off from that level. So that is going to be a very important resistance to watch for Square. Talking about Meta platforms, and Meta here on the day slightly higher, 25 basis points. So it did gap down, buyers stepped in, pushed right back up, green candle on a green day. Resistance is going to stay put at 188, close to $189. So that right there is going to be that level to watch. And we've got a lot of gaps to fill here on the downside and on the upside for Meta. So those right there are going to be some levels to watch along with this previous resistance where we are waiting for Meta to get up to 205 to 237 for this company. Talking about Netflix, and Netflix did get a bit of a bounce. You can see that this is the higher low that we've been talking about, and we've got the RSI and the MACD really oversold. So it's not a surprise that Netflix is getting a little bit of a bounce here from these levels, up 1% on the day here. So again, oversold. So it's not surprising that we're seeing a little bit of a rebound and a reversal for Netflix from these levels. Google was up another 0.5%, so it continues to push higher a little bit, 94.65. Our target's still up to as much as $103 to as much as $105 per share. That's going to be in line with this lower high and the 200 simple moving average that we have on the chart. And support level is going to stay put roughly at around 90, sub 90 levels for Google. Microsoft on the day was flat, down 18 basis points. So still in the context of this downtrend, but I do like Microsoft in the 220s now. So if it does come down to those levels, I would very much be interested in buying in and around these levels at 218 to 24 Microsoft. But of course, right now, just consolidating sideways. The valuation is still a little bit on the expensive side, in my opinion. So we'll be keeping close eye on Microsoft as well. Last but not least, Shopify here, pushing higher a little bit, up almost 3%. Support level is going to stay put at $40, $41. So that right there is going to be that level to watch. And we do have a pretty strong gap to fill here. It's at roughly $40 to $49, all the way up to $54 per share for Shopify moving forward. So lots of consolidation there. Slowly and steadily kind of making these higher lows at the moment. So we are pushing higher really nicely at these higher lows for Shopify. And resistance next all the way up to that 300 SMA to as much as $54, $55 per share. So hope you guys enjoyed this video. Bottom line is, look, economy-wise, macroeconomics-wise, and just looking at the consumer spending and earnings and all those things, in my personal opinion, don't look super great. I wish I could say otherwise, but unfortunately, the data that I'm seeing, unfortunately, everything that I'm looking at, it doesn't look great. So we got to definitely prepare for potential stagflation or worst case scenario, a deflationary depression in the US if money supply continues to contract so severely because of quantitative tightening from the Federal Reserve. And eventually, inevitably, in my opinion, something could very much break in the economy. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe to the channel. The link to our Discord and Patreon is going to be down below. So always happy investing, and I'll see you all in the next video.